Alrighty, welcome everyone to this week's Sunday macro wrap up for Sunday, August 31st. Hope everyone is having a fantastic Sunday wherever you are, and that everyone was enjoying the comeback of college football, as well as I think this Thursday we have the first NFL game. So it's definitely good to have American football season back up and running. Great to see the Gators out there on the field, even though it was pretty much a team that's high likelihood of winning, but still good to see them out there. But yeah, welcome everyone to tonight's Sunday macro wrap up. Last week, it was kind of a lighter week in terms of macro data, but there was still a lot of really great information as well as topics of discussion. I know right now the news is kind of flooded with the whole drama in the Fed right now. One member who was fired by Trump. All that really is kind of a distraction, in our view, from what's really going on, which is this tug of war between inflation fears as well as recession fears, right? And so, obviously, right now, whenever there are signs that inflation could remain sticky and not come down as much as it would like in order to prompt the Fed to continue the rate cutting regime, then that obviously is something that the market is not liking at this point in time. As we saw on Friday, the S&P 500 had a pretty decent little pullback there. Let me see if I can bring it up here. And so, really, there's some interesting dynamics going on the charts that I will cover later on in this video here after we go over some of the macro data. But yeah, it was an interesting little dip there. Still, new all-time highs for the S&P 500 on that Thursday. And so, what's really interesting is that despite the S&P 500 making new all-time highs, each week it seems like at this point, you continue to see that right now retail sentiment is fairly bearish still, which is something that was definitely not the case going on this time last year when, when we continue to see the S&P 500 make new all-time highs, but the retail sentiment was very bullish, right? And so, definitely a different dynamic that's going on this year. And I think that the news is really just taking hold of a lot of the different narratives and the sentiment. When really, if you're just following a process, then you'll remain in the right investments here. So, all right, let's go ahead and get into some of the different macro data here. For those who are joining for the first time, welcome to the Sunday Macro Wrap-Up. The way that these work is that they're an hour long. The first 30 minutes is streamed online on our social accounts, and then the last 30 to 45 minutes is actually offline just for our Macro Optics members, which will answer questions and actually get into some of the actual ideas that we've been talking about in the community. If you guys would want to check that out and join the discussion for the other half of this, as well as take a look at what our community is all about, we have a 7-day free trial of our membership tiered community. And so, yeah, you can just go on our website or just go to any of the links below, and you can learn more about that there. All right. So, obviously, the big thing that happened last week was NVIDIA earnings, right, which we got, I believe, on Wednesday of last week. And so, what was interesting is that even though it was a earnings beat, you have to recognize the year-over-year change in revenue growth continues to decelerate, right? So it's accelerating, but at a slower pace, right? So there's a deceleration there, and you can see that really by just looking at these year-over-year numbers, starting all the way from Q4 of 2023, right? 265% year-over-year, 262, 122, 93, 77, 69, 55. So even though they're just looking at the nominal number goes up for revenue, the rate of change of growth is actually slowing. And so specifically looking at the 2-year stacked growth, right? So looking at Q2, the year-over-year growth for Q2 of 2025 compared to Q2 of 2024, the growth shrank more than half. Okay, so that was the big thing that we saw with NVIDIA. And then with core PCE price The headlines on the mainstream media, they just report the month over month number, and so that remained flat. But of course, you have to look at the year over year price change, which that actually accelerated back to February and December 2024 levels at 2.9%. And so, as you can see, core PCE, which is the Fed's preferred inflation gauge, that has been rising for 3 consecutive months in a row. And so, if you zoom out on a 10-year basis here, you can see that, pretty much the average of this pre-pandemic, right? So right around, let's see if we can go even farther than that. Yeah, so pretty much if we just want to do, late 90s to today, you can see that the average inflation rate for core PCE was around, 1.7% ish, right? 1.6, 1.7%. And so for it to be at 2.9% is way higher than the average, right? Nowhere near their target. And so, if the Fed was going to be cutting rates pre-pandemic when inflation was at these levels, that would be unheard of. That would be like something crazy happening in the news, right? It would be unacceptable if this was pre-pandemic times. And so obviously they're trying to figure out what's going to be, are we heading into more of an arena where we're getting an accelerating or a decelerating labor market, right? Where the labor market's getting worse, or is inflation going to kick back up again? If we take a look at the Cleveland Fed's inflation nowcast, they have core PCE for August, so this month being reported at the end of September, going up from 2.9% to 3.0%. Even though it says 2.95, it'll be reported rounded up, so 3.0%. And so, this time next in September, we could see this going back up to 3%, which we haven't seen since, when was that? March of 2024. And so if that happens, you could see a definite pause in the rate cutting regime. So that's the whole thing that's happening right now. But, taking a look at the Fed meeting probabilities for the September meeting on September 17th, there's still an 87.4% chance, according to the Fed Fund Futures market, that they're going to cut by 25 basis points, and then a 12.6% chance that they're going to remain paused. And so that has pretty much remained the same there. And so they're most likely going to cut by 25 basis points. The only problem is that this could be a situation like we had last year in September of 2024, where they cut by 50 basis points and then interest rates went up. So there is a scenario where, and we just saw this, where if they cut rates, the actual interest rates that you and I pay, 30-year fixed mortgages, credit card APR, all of that could actually go up or remain sticky. Excuse me. And so, yeah, that's something that was interesting that we saw last week. We also got the home price indices. So there's two of them. There's one by the FHFA, and then another one by S&P Global. Those both continued to decline to very low levels. And then if you guys follow this guy right here on Twitter, Nick Gurley, he has a really awesome website called the Reventure app. I use it myself just to look at different trends. And, I'm not sponsoring him or anything. It's just, a tool that I genuinely use. And he posts really good content on X, Twitter. I would highly recommend that you guys follow him. But he did a post last week, or I believe this was on Friday. And, he was just showing some records where there's a really big problem with demand right now, right? So you have record low pending home sales. You also have, let me see here. Where's this other graph? Buying versus renting, mortgage costs versus the average cost to rent. Look at that huge gap. And then also too, when just taking a look at real home prices. So this is home prices adjusted for inflation. This is already adjusted for inflation. And so as you can see, this is clearly at the peak here, and it's, prices have been slowing, and it's looking like this is starting to, peak out a little bit. The last time that this happened was in 2006, where it peaked, it surged really fast, then peaked, and then came back down. And so the real big culprit in his analysis, and he does a lot of really great videos on his YouTube page, which I would highly recommend you guys check out as well, because he goes into a lot more detail on this. But essentially, the data that he's seeing is that, especially with existing home sales, that sellers are just not giving in, right? Their neighbor may have sold a house in their neighborhood a couple years ago during the peak of the housing market, frenzy, and they sold it for 600,000, and now they have that price point stuck in their head, and they're just not letting prices come down at all, right? Even though some of the ones on the market have been, at the same price point or hovering around that, maybe within 10 grand, for, over a year, have just been sitting there. And so this is typically what happens, right? You have seller denial. You saw this back in 2007 as well. Now, I'm not saying that we're going to have a 2007 type crash in the housing market. The scenario is a lot different, but we're starting to see a lot of similarities there. And so it is interesting, even when you look at specific housing stocks, you see the actual supply side continue to rise, whereas the demand side continues to fall. And so you can just look at the price charts for that, as well as specific stocks. So, you could have a lot of the disinflation come from shelter, which is one of the largest parts of the CPI number, as well as oil. So, even though some of the consumption-based, inflation might be a little bit more sticky, you could see that the shelter component continues to bring inflation down or is counteracting the inflationary components of CPI. Really tricky situation right now. All right, heading into this week, always the first week of every single month is labor data week, right? So the first week of every single month, we get things like job openings, which, continues to decline. It has flattened off a little bit in terms of the rate of change, but job openings continue to slowly decline there. We also get challenger job cuts. This had a little bit of a spike there from back in March of this year, but then it came back down to normal levels. This was mostly from the large amount of government fires that were happening at the federal level. We also have the employment change for private jobs, according to ADP. And that actually had a rebound from the negative 23,000 that we saw in June. That was the first negative print since March of 2023. We also have U6 unemployment rate. So the headline unemployment rate that you see on the news is called the U3 unemployment rate. But what my team and I like to look at, as well as many economists, they like to look at U6 unemployment, which also includes people who are not categorized in the unemployed box and are also in the quote unquote not in the labor force but are still looking for a job. And so this captures the actual unemployment rate a lot better. And so this right now is at 7.9%. This did get up to 8% in February. And so if you do see a large acceleration in U6 unemployment, that's when you should really start paying attention as well. So that comes out on Friday. And then, of course, we get the traditional non-farm payrolls report from the Bureau of Labor Statistics. And I typically just look at the private number because, again, the majority of the jobs in this country are private jobs, from the private sector. And so you want to filter out a lot of the noise with government job distortion. What else do we got? Well, as you guys can remember, there was a lot of the labor market data from last month or earlier in August. We had that whole revision scare, right? And so our team and I, we keep track of this stuff ourselves as we take the raw data and put it into our own charts just to get a better visualization. And so what's interesting is that, all of a sudden, just because the rate of the revisions started to decelerate, we've actually had, out of the last 24 months, right? So the majority of the past 2 years have actually been negative revisions, but because these are just a little bit more than usual, on a 1 to 2 month term, that's when people decided to pay attention. But if you look at the cumulative, I mean, the last 2 years have mostly been negative jobs revisions. So, um, it's nothing out of the ordinary compared to the last 2 years as the market continues to make new highs. And so, yeah, I think that it's just because we had 2 large months of negative decelerations. But again, look at all this big chunk here that's negative. It's nothing new. We also get the ISM Manufacturing and Services PMI. Now, these two metrics are probably the most important in my view, specifically the services PMI. And so this is the ISM Manufacturing that continues to decelerate. And then we also have the ISM Services PMI. Now, out of those two, the ISM Services PMI, in our view, is probably the most important metric of the entire week, which, you probably won't hear that in the mainstream media. But the reason why is because in services, I talk about it probably almost every video, but I'll keep saying it. The United States is a service-based economy. When you take a look at services, it makes up over 72% of the entire GDP number. And so that's why you have to pay extra attention to the services PMI numbers because, if this starts to really go into a contractionary mode for 3 consecutive months in a row, which we have dipped down into it, which is below 50 is contraction. In May of 2025, just a couple months ago, that happened. And then it also dipped below that as well back in June of 2024, April of 2024, and December of 2022. And so far, we haven't had those 2 or more consecutive prints in contractionary territory, but, we are trending that way as we peaked there in October of 2024 and then continued down further. And so, I do think that there is, if this continues to go into contraction, I mean, there definitely is a base case for the Fed to cut rates, but it's very tricky because, just that we have to see more data from all the tariffs and stuff like that. But yeah, it really doesn't help that core PCE continues to accelerate. But we'll see what happens from here with that. And one thing that I highlighted with the services ISM is breaking it up between new orders as well as prices. And so as you can see, new orders, which is, demand, continues to decline as prices continue to rise, the price index. If you go back just the last 10 years, if you take a look at, ever since the lows back in March of 2024, the price index of services has just really started to pick up, right? Just look at that surge. The last time we really had it surge like this was in March of 2021. But you have to look at the relationship between both new orders as well as prices. And so this time last month, I was highlighting that really there's only been one other time where we see services prices surge above the 67 index level, while at the same time, new orders falls below consecutively the 54 index level. And the last time that we saw that was November of 2007. And so obviously something is really broken when you have services prices continue to rise while at the same time new orders continue to fall. This is a very rare setup. You don't get this very often. And so, it just lines up with a lot of these key turning points in the economy. And yeah, there's obviously some buildup happening right now. Now, with all of that, these are very slow moving changes. One thing that I've learned is that when you start to see these earlier signals, that's not a sign to like go ahead and be like, oh my gosh, I got to go into cash and sell everything, blah, 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 panic mode. No, you don't want to do that at all. The market is really good at giving you early signals in the price charts as well. So it's not like you're going to wake up the next morning. It's possible, but it's very unlikely that you're going to wake up the next morning and the S&P 500 is down, 30%, right? Typically, you see things start to crack a little bit, and then they start to decline. People go into denial, and then they start to buy dips when they aren't actually dips. It's actually a turning point, and we're definitely not at that point just yet. So these are all just things to take into consideration, so that you can plan accordingly when we do start to get more of a turn in trend with the large indexes and stuff like that, which I mean ultimately will happen. Um, and typically they are short-lived, and it's typically a buying opportunity as well. So never be afraid of recessions, never be afraid of pullbacks. Ultimately, if you just go back in history, all those are just great opportunities if you are positioned and prepared for them and are paying attention to all this stuff. And so, yeah, that's what we try and do simply here on this channel. Sometimes we can definitely, do it a little bit more better. But we're getting your guys' feedback, and we appreciate everyone for joining these conversations here. But I took a couple notes here. One of the big things that I saw last week was gold made new all-time highs. So the price of gold per ounce finally closed above this $33,430 per ounce threshold. And if you go back all the way back to late April of this year, it's had nearly 4 attempts of breaking through this, and it just did. And when you zoom out on this chart, I mean, gold looks like it's about to have a major breakout here. And so, that's definitely interesting, considered all of the macro data that we just looked at, right? Gold is considered a flight to safety during a lot of these troubling times. When things actually break, though, gold is typically the first thing that people sell when they're needing to raise cash or they're getting margin called. So, I mean, at some point, everything goes down together. But it is interesting that we're starting to see gold look like it's done with its little consolidation period there, and it's starting to break out of here. But it's not just gold, right? You also have gold miners, which are in a much greater bullish trend. I don't really hear too many people talking about gold miners, but this is just, I mean, it's going parabolic right now, as well as junior gold miners as well. So this has been bullish in our model, pretty much since fall of 2024. And it really started to pick up here early in 2025. And so, yeah, I mean, this is clearly an accelerating rate of change by just, if you squinted your eyes and just looked at this chart, or instead of having it on candles, if you just have it as a line chart, you can clearly see how this is having an enormous breakout there. And it's not just gold. You're also seeing silver. So silver as well, and that is also kind of pointing to inflationary fears. When you see both gold and silver break out like this, and yeah, silver miners are also going pretty wild as well. So precious metals and precious metal miners, those types of stocks. There's one in particular that my team and I have liked for quite some time. That's continues to make new all-time highs. But yeah, gold and silver and their minor stocks, man, they've just had a heck of a year so far in 2025. And we want to hear more people talk about that. But what is interesting is that at the same time as gold and silver are doing what they're doing, in my notes, I have that Bitcoin is having a very interesting signal here, as for the first time, I think since mid-February of 2025, Bitcoin just went neutral in our model. And it's looking like it's continuing to break down here and possibly going bearish trend. I don't think it has just yet, but yeah, Bitcoin is typically a signal of liquidity as well as, growth conditions. And so with Bitcoin breaking down like this, I also pay attention to it as a liquidity monitor as well. And so with Bitcoin breaking its bullish trend to go to neutral, that is very interesting and definitely a signal that you don't want to ignore. The way that our process works is that when something goes from bullish to neutral, what we want to do is we want to stop adding to it, first of all. So stop buying dips. And then if it does break down to bearish, then you just get rid of the position and be patient for when it goes back to bullish trend. It can, things can definitely go from bullish to neutral back to bullish, but typically on a trending basis, it's very unlikely, and there's just a high probability that it goes from neutral to bearish. So Bitcoin, definitely an interesting thing to pay attention to, but not similar to gold and gold miners and silver miners, Bitcoin miners, so Bitcoin mining stocks, pretty much or really got close to an all-time high here. So this is the Bitcoin mining ETF WGMI. Some of the Bitcoin miners have been doing pretty well, and yeah, so that's very interesting as Bitcoin prices are starting to turn over a little bit. But that's a great sell signal for Bitcoin miner ETFs or Bitcoin miner stocks as well. MicroStrategy as well as Coinbase continue to struggle here. If my screen wants to load, so that is indicative to what Bitcoin is doing. And then after NVIDIA earnings, you did have a decent sell-off here. NVIDIA, as well as the majority of the top 10 stocks, according to market capitalization, the majority of those are bullish trend. What is interesting is that Berkshire Hathaway actually went bullish this past week as well. When it was bearish, it went neutral in our model on August 19th. And then it just went bullish here on August 26th. So that's an interesting development as well. This thing was really bullish when everything else was bearish. And so this is, kind of an opposite correlation with more of the growthier type of sets that we've been seeing over the past couple months. One of the key metrics that I like to look at in terms of a risk on or risk off environment, and some of you guys have seen this before, is the consumer discretionary versus consumer staples ETF ratio. When this ratio is going up, that's typically a sign of a risk on environment. And when this is declining, it's more of a risk off or defensive type of environment. And so, this ratio is clearly in a bullish trend, which is signaling still more of like a risk-taking type of environment. And so, I'm not saying all these things to go completely bearish on the market yet, because the S&P 500 is still very much in a bullish trend. That has not had any type of signals that it's going from bullish to neutral at all. But as well as when you take a look at credit spreads remain at very historic lows and remain incredibly narrow still. And so, yeah, the last time that credit spreads were this narrow was obviously earlier this year, as well as late 2024. And then the last time before that was all the way back in July of 2007. So, yeah, the risk on environment is at very much historical levels here. And so as that remains this way, you don't want to be too uberly bearish. And so again, I definitely understand why a lot of retail traders are bearish, but that's just not the signals that we're seeing in the markets right now, in the actual trading markets. And so one last thing that I'll touch on is the 5-year break-even inflation rate. I would highly recommend, if you guys are not paying attention to the 5-year break-evens, that you look at this, because this is essentially the bond market's way of pricing in future inflation expectations. Because we go ahead and look at like the futures market, we look at Cleveland Nowcasts, but you also want to look at what the bond market is saying. And what's interesting is that, taking a look at what this level was all the way back in September of last year, in 2024, when the Fed cut by 50 basis points, this was near 2%, right? So way closer to their 2% goal. Whereas right now, a year later, they might be, or they are most likely going to cut in September by 25 basis points, but we're a whole 50 basis points higher than this time last year. And so, what the bond market is clearly saying is that the Fed is about to make another policy mistake here, right? And so, this is a very interesting setup here, and very uncommon. But yeah, you could be in a little bit of a trouble scenario here, not immediately, but maybe sometime in 2026, where things just get out of control either way. Whether we have a very stark slowdown or inflation just gets out of hand again, and maybe they have to stop cutting rates like they did last year, right? They cut by 100 basis points and then they stopped for nearly an entire year. So we'll see what happens. You got to pay attention to what the bond market is saying, especially on the long end of the curve, right? So 10-year U.S. government bond yields, 20 and 30-year. And so, when taking a look at the 30-year U.S. government bond yield, that remains near 5%. And yeah, so the bond market is definitely saying to the Fed that I'm not sure if cutting rates would be wise, but they'll probably end up doing it anyway. So that's all I have for you guys here. We'll go ahead and just take a look before we hop offline, just for our Macro Optics members. We'll go ahead and just go through some of the key points here. So over the past 5 days, or over the past week, you really saw a large acceleration led by the energy sector. So XLE was the biggest winner of last week in terms of factors. Small caps continued to outpace the S&P 500, which is definitely interesting. You're also seeing that similarly in the crypto markets, right? Because Ethereum is outcompeting Bitcoin at this point in time. You also have currencies. Taking a look at these other currencies here versus the U.S. dollar. A lot of them are bullish versus it. And then let's see, this past week, that is. And then if we go to countries, the biggest winners of last week were Brazil and Canada. On a 1 month basis, it's been Brazil, Chile, Peru, Colombia, a lot of those South American countries. And China has also been doing well. Spain, Italy, Turkey, Greece, those have been the leaders this year in terms of country ETFs. But we're at 8:30 here, right at the halfway points. And so what we're going to do is we're going to go offline to the second half of this discussion. Again, if you're joining us on our stream, you can go ahead and click the link below to join in on that conversation using the 7-day free trial there. But we're going to go ahead and say bye to YouTube, TikTok, Instagram, as well as X. And we're going to go offline here just for our group. Hope you guys have a great rest of your Labor Day weekend. And yeah, we will catch you guys on Tuesday. Bye, everyone.